Hello, M&A scientists. Welcome to the M&A Science Podcast, where we learn from the best in M&A to uncover proven techniques for enterprise value creation. If you're interested in learning more about the products and services we develop to support world-class M&A teams, or want to get involved with our community of forward-thinking M&A practitioners, visit mascience.com. You can get started by subscribing to our free weekly newsletter for the latest insights and events. Again, that's mascience.com. I'm your host, Kison Patel, CEO and founder of M&A Science. Joining me today is Doug Barnard, Executive Vice President, Corporate Development and Legal Advisor at CF Industries. CF Industries is an American manufacturer, an S&P 500 chemical company based in Northbrook, Illinois, a suburb of Chicago, traded on NYSE under CF. Today we're going to talk about how to overcome challenges in M&A to increase deal success. Doug, how you doing?
I'm doing great, and thank you for having me here today, Kison. Admire what you're doing and looking forward to our interview.
We are here live in the M&A Science studio in the heart of Chicago. So thank you for coming down and make this happen. We don't get to do too many in-person interviews in our studio, so I'm glad that you made it down.
Very exciting.
Maybe why don't we kick off a little bit about your background?
Yeah, sure. So I've been doing deals for a little over 40 years now. I was a partner in the private equity practice group at Kirkland & Ellis. And after that, I've had 3 general counsel roles. The first one was with a PE, private equity portfolio company. It was pretty large. It had 30,000 employees in multiple countries, mostly in Asia. After that, general counsel with an advertising group based here in Chicago, but with 500 offices in 90 countries.
Wow.
And for the past 20 years, general counsel at CF Industries. CF Industries, like you mentioned, S&P 500 chemical company, $11 billion in annual revenue, $6 billion in EBITDA, and $15 billion in market capitalization. I wanted to tell you an interesting story about how it all began 20 years ago at CF. When I joined the company, it was near bankruptcy. It had lost a lot of money for 5 years in a row. I helped take it public 1 year later, about the same time that Google went public. And astonishingly, over the next 10 years, as newly public companies, CF stock outperformed Google stock for that 10-year period. So it was an amazing turnaround from near bankruptcy when I joined to the company that it is today.
That's a big win. That's a big change to be on the inflection point.
I'll just mention one other thing, since this is M&A Science. I guess you could call me an M&A scientist. I have a bachelor's degree in physics from MIT. And an MBA in finance and accounting from Chicago Booth. So I like your M&A science approach.
Hey, I love it. That's what we're always looking for, is growing this community with more scientists. But and it's really interesting. I was looking at your background. You've worked on not only a lot of deals, but you've worked on a lot of big deals.
I have a wide range from small to middle market to multi-billion-dollar deals over the years, particularly at CF as the company grew so dramatically. And in the chemical industry, deals come in what you might call bet the farm sizes, billion on up. So, most recently at CF Industries, a number of multi-billion-dollar type deals.
Yeah, when you look at back and you summarize your scorecard, is it number of deals or total transaction value?
The way I measure my own performance is what I like to think of as batting average. of all the deals where I get involved at the outset, how many get all the way to the finish line? And I think we're going to talk about some of the ways a deal practitioner can increase their batting average. Make sure that if the deals you work on should happen, they get done.
Awesome. I'll get your score at the end then. So before you even start a deal, what kind of mindset should you have to be prepared for surprises that come up?
I think in order to improve your batting average, there are two things I always try to do at the outset of a deal. One is to understand the lay of the land better than anyone else. And the other is to always act like and come across as an honest broker. Because if people come to trust you and they realize you know the lay of the land, they're going to allow you to work your magic, find ways to find common ground and cross off issues one by one. So what do I mean by lay of the land? I think there are 3 or 4 components that go to the lay of the land. The first is to try to understand the relative negotiating leverage of the buyer versus the seller. And that's equally important whether you're the buyer or the seller, representing the buyer or the seller. So what goes to relative negotiating advantage? One important aspect is whether the seller has alternatives. Are there competing bidders? If it's a pre-IPO target, is an IPO an alternative to a sale? And maybe if it's in a strong growth phase, maybe the seller might decide just to defer selling it if the time isn't right. Another component that goes to leverage is whether the buyer has synergies, and if it does, how that compares to competing bidders' synergies. And I think the third component of leverage is whether or not this acquisition is strategically important to the buyer, because buyers behave very differently if it's strategically important to them to get the deal done. Otherwise, they're very price sensitive and they just want the lowest possible price for yet another deal that isn't strategic. I also, learning the lay of the land, try to identify impediments to closing. For example, the need for regulatory clearance, increasingly difficult today. The need for financing, as opposed to a buyer that can just write a check without financing. And then, how long is it going to take to get regulatory clearance, to raise financing, and so on. And ultimately, what is the likelihood of success or failure if the deal hangs in the balance on regulatory clearance or financing? Yet another part of lay of the land is, where is the buyer on the learning curve? Does the buyer already know going in just about everything worth knowing about the target? Or at the other extreme, will they need to do a lot of due diligence to get comfortable and understand what they might be buying? And I suppose the last thing I mean by knowing the lay of the land is to do triage on the negotiating issues. Is it an issue on which the buyer and seller can likely agree? Can they at least find common ground if it's a little contentious? And the third triage category would be what I call zero-sum issues, where someone will win and someone will lose. And once you know the lay of the land and you've done triage on the issues, really where I think deal professionals can add a lot of value is turning those seemingly zero-sum issues into issues where there is common ground, so that the parties can put that issue behind them and get to closing.
Okay, so we had these different areas. We had, in terms of lay of the land, we had negotiating the leverage, knowing what the alternative options are, if it's to go IPO, if it's to look at who the competitors are. Then you had the specific synergies, the competitors, how they look at the deal and their synergies. And then you have the various impediments to get to close. Is there some regulatory requirements and things of that sort? And then as you get to close, it's negotiating the issues that come up and how you triage that. And that's where I was curious if you had specific examples around that.
We may get to that. I just want to say, in many deals, leverage depends on whether getting the deal done is strategically important to the buyer. Because if it's a must-do deal in some sense, it changes the negotiating dynamics. But leverage is always important. Most important when the buyer wants it so bad it hurts. When it's strategically important to them.
What if it's the other way around, Doug, where you're looking at a company and they're in bad shape, revenue's declining, and you're looking at this thing like, I don't know who else would buy this thing, and this is maybe that one. You still see some strategic alignment there, but it's going to be a lot of work to make this thing work out.
I do have an example. CF used to have a second business line, and it was a business line that year after year for 10 years had consumed cash rather than generated cash. And I was tasked with selling it. And so how do you find someone willing to pay a meaningful amount for a business that consumed rather than generated cash year in and year out, even in good times? And I was able to get that business sold and that deal closed because I recognized it was strategically important to the buyer to expand in its existing business line. And so in negotiating with my counterpart, I decided it would be a losing approach to focus on numbers, financial metrics. So I negotiated with just one piece of paper, and it compared the relative size of the buyer to our cash-consuming subsidiary in the buyer's own industry. And then I said, well, Wall Street analysts think your company with your size is worth X. I'm guessing you think they have it wrong, that your company's worth even more than the Wall Street analysts claim. So you just have to scale that down to our target, which is like a smaller version of you, and that equates to X. And that worked. The opposite, more traditional approach of saying, well, here are the historical financials. We think you can, maybe actually generate cash some year if you play your cards right, would never have worked. So it had to be reframed that way and couldn't have been if the buyer didn't view it as a strategically important deal instead of one driven by the numbers.
Wow. One person is trash, another person is treasure.
Yeah.
You figured that one out.
So, but in some sense, you've seen one deal, you've seen them all, but I think it's more accurate to recognize that every deal is different. And I think they differ along these dimensions I described. So if you master the lay of the land and you come across as an honest broker, you can usually find a way to get any deal done as buyer or seller.
Can we talk more about the honesty part? Because I think that part doesn't get talked about a lot, where there's a relationship you need to develop, which essentially gives you that foundation of trust. I feel like if you fundamentally don't have that, you're not in a great position to get the deal done.
I think it's easiest to get people to accept you as an honest broker if you have a substantive, deep understanding of the lay of the land. You know what, if you're representing the seller, you know what the buyer, why the buyer wants to do this deal, vice versa. And if you've given some thought to the likely open issues that need to be negotiated, and you have come up with approaches issue by issue, how you can find common ground and explain, why that's where the common ground lies in terms that the counterparty understands, because you understand where the counterparty's coming from. It turns into more of a workmanlike instead of contentious process. So in order to be an honest broker, I think you do need to know the lay of the land better than anyone else. And once you know the lay of the land that well, it's relatively easy to work constructively instead of contentiously.
I mean, are you being pretty objective then, where you're essentially sharing the cards or your perspectives? And
yeah, I think it's the rare issue where the common ground is razor thin. Usually there's a range from pro-buyer to pro-seller within which both parties could agree if it came to it. So depending on whether you're the buyer or the seller, you're representing the buyer or the seller, you want to scope out the most favorable part of the common range issue by issue and try to get most, ideally all the issues to land in the common range so the deal gets done, but at your end of the common range issue by issue.
Can you have an example of that?
I'd have to give it some thought. But it's an approach I've used deal after deal. I was thinking heading into this interview, trying to estimate how many deals I've closed. It's probably over 100.
Wow.
And so I found that approach works best in terms of batting average. If applied consistently, deal after deal, whether you're buyer or seller.
And so just kind of here's the issue point, and then we're basically looking at the common grounds, but there's a definition of common grounds between both sides, and really figuring out where there's a nice mutual overlap that doesn't stretch it too far.
I've thought of an example. And it goes to synergies. Mm-hmm. If you might have a financial buyer, in which case they probably don't have any synergies unless they already have portfolio companies in the same industry and it's a roll-up, then they would have synergies, but often financial buyers don't. But strategic buyers almost always have synergies. In other words, there's value created if they add the target to their existing business in the same industry. So the synergy, in some sense, is the fair market value. It's what's on top of the fair market value, the value created in the buyer's hands, adding it to the buyer's empire. And so that needn't and usually doesn't go all to the buyer. In a competitive situation, the seller can often end up with most approaching all of the value created by adding this target to the buyer's empire. So the common ground is the range between the fair value, what a financial buyer would pay if it had no synergies, and the bigger number where you add in the synergies, the value created by putting the buyer and the target together. So once you recognize that that is the range where the parties, could, if you play your cards right, agree, then if you're the buyer, you try to save for yourself most all of the synergies, the value created from the deal. And if you're the seller, you try to extract most all of it for yourself, since the buyer is going to realize the synergies if they're real.
How transparent do you see the buyers in terms of, hey, here's our model, this is how we're modeling this deal out, and where we've identified synergies?
It usually comes out automatically in a competitive auction, where the competition drives the deal price higher and higher until one by one people with inferior synergy drop out. It's become uneconomic for them, leaving, in theory at least, just the buyer with the greatest synergy of all the bidders. I think it's the rare counterparty that will put its cards on the table about something as central to the deal as the price. But you can often estimate the synergies from outside looking in.
Then how do you negotiate that? Because if I'm a seller and I'm trying to take your lens into, I want to make this deal strategic. I get a sense from this buyer there's a lot of value because they've got this massive distribution. They're going to be able to add this product and quadruple sales in a matter of a couple of years. And I guess how do I acknowledge that, but then start negotiating off of that and saying, hey, well, this is how much value it's going to create. This is going to be worth X dollars because of what I'm interpreting from the value you're going to realize.
It may be more of an art than a science in the end game. Mm-hmm. I once worked on a divestiture of 40% of the public company parent. It was a competitive auction. I was with the seller. We opened all the bids, and of the 4 or 5 bids, the highest one stood well higher than the other bids. So our investment banker, without batting an eye, called the bidder that had put in the meaningfully higher bid than other bidders and said, "You're close, but if you add another $100 million, it's yours." Even though that bidder had already put in a far higher bid than the other bidders. That bidder swallowed hard, added $100 million. And so that's kind of the art of negotiating in an auction.
Yeah, you got a little playing some poker games here.
Yeah. So it's part science, just estimating what they could afford to pay and still come out ahead with the estimated value created by buying the target, or you can play poker and just come up with some way to test your hunch that they have more in them. And of course, few buyers lead with their final and best offer. It almost goes without saying they have more in them. The question is how much and how to extract it.
How do you get good at this of just, because I feel a lot of people don't have this in terms of, you got to be in the business for a while to start looking, valuation, understanding that valuation is based on the buyer's perception of the value, and the synergy part of it. How do you get good at that, of just starting to identify and looking at companies and how they would find synergies in deals?
I approach it, maybe from the other direction. I spent, roughly 10 years in private practice representing PE, private equity buyers. And they usually didn't have any synergies. And so they were loath to participate in auctions, competitive bidding situations, where there would be other bidders, strategic buyers with synergies that they didn't have, value created that they couldn't create. And so PE buyers will often take a pass on competitive bidding opportunities with strategics bidding against them, and fish in different waters, try to get exclusive looks at something for sale. How do you get good at it? I think it's just working on enough deals till you get the hang of it, thinking about what's going on and why, and then playing some of your hunches and seeing what happens.
Yeah, it's almost like you got to get in their shoes. You got to
Yeah.
get in their mindset and try to think of.
Well, you could do a lot worse than learn enough about the counterparty and see the deal through their eyes. That helps you negotiate against them. It also helps you identify the common ground to put difficult issues behind you and get the deal done. And if you are inherently fair and you come across as fair and knowledgeable, it's happened a number of times in my career where both parties just look to me to find ways to resolve issues and trust me to do something fair for all concerned.
Have you found anything like unique for information gathering in terms of like, are you listening to earning calls or certain things that really give you some good media information to help you with that?
Yeah, it's, on the subject of earnings calls, AI is newest on the scene.
Yep.
And traders on Wall Street are literally turning AI loose on earnings call transcripts, looking for clues, what's said, what's not said, words chosen. But back to my example of trying to sell our cash-consuming business, I spent some time confirming my hunch that the eventual buyer would probably find this a strategically important acquisition and might be willing to let a little thing like cash consumption rather than generation, be secondary.
How about when you're moving along the deal? Like, when does it start getting tricky and problems start surfacing?
Not, typically not at the outset. It's the honeymoon phase. Both the buyer and the seller would like to see the deal happen. So they work together to build momentum. And often that means postponing dealing with some of the more difficult and contentious issues. Once momentum has been established, the lawyers, the tax professionals arrive on the scene. And so in most deals, that's when the elephants on the table become evident. The contentious issues, the difficult issues, the zero-sum issues, are revealed. And so that's when the going gets tough and when it's really important to see if there's some way to turn the so-called zero-sum issues into common ground issues. And if you're creative, you can turn more than a few seeming zero-sum issues into actually common ground issues, and then steer towards something both parties can accept as you march towards the finish line, closing. So the difficult issues normally surface when the lawyers and tax professionals first get involved, but sometimes additional difficult issues surface during due diligence. And that really turns on whether the buyer already knows the target, same industry, for example, like the back of its hand, or is going to be getting up to speed through due diligence. And occasionally, some amazing things surface during due diligence. Not often, certainly not always, but you do 100 deals, I've seen some astonishing things come up during due diligence.
When we say astonishing, you mean like surprises?
Yes.
I would love to get examples because I feel like this is what you don't learn in textbooks. But if you can share some examples of surprises you've seen in diligence.
Yeah. So I'm going to give 5 examples. The first 2 came to light when lawyers and business people plowed through the data room. The 3rd, 4th, and 5th issues are probably not the sort of things you would ever find in a data room. They were uncovered through the use of private investigators.
Okay.
All right. So first, the 2 data room examples. In one case, the target company had grown through a roll-up strategy, buying companies in an industry from entrepreneurs. And in order to keep the entrepreneur's head in the game and get those roll-up acquisitions closed, they had handed out little deal by little deal by little deal, bespoke equity or equity incentive packages. And I was representing the buyer, and when we saw how pervasive these arrangements were and how bespoke they all were, our client, a financial buyer, threw up its hands because it was very difficult to model how much they would get as the PE buyer versus the entrepreneurs in terms of future value created. It was almost impossible to model. So that was one, and that literally killed that acquisition.
Wow.
Another one was where the target company was a manufacturer, and by license from a third party, it had the right to use a well-known trade name on its heavy machinery. But during due diligence, the buyer learned that the extremely important license to use the trademark would evaporate on a change of ownership, especially because the buyer competed with the third party that had licensed in the well-known brand. That one got solved, but it was critical to the value. A lot of the value of the target would evaporate if it lost its right to use the well-known trademark on its heavy machinery. So those were 2 data room examples. The 3 learned through using very sophisticated private investigators in each case. One case, we discovered massive bribes of foreign government officials, extensive trading with enemies of the state on the OFAC list. And so needless to say, that killed that deal. Another stranger one was where the target had sizable operations in a third world country, and we learned through a private investigator that the foreign government had silently appropriated the operations in that country, and the operations in that country were a sizable fraction of the global operations for the target. By silently appropriated, I mean they had repopulated the board so that the government had a majority of the board. They had replaced the in-country general manager and had silently appropriated the economics of the entire operation in that country. Again, that's the sort of thing that kills deals, and you're never going to learn that in a data room.
Wow.
And then the last example, in some ways stranger still, we learned, again representing the buyer, entering a new industry in a new geography, that the entrepreneur of the target, someone on whom they'd be completely dependent if they bought it, entered the new industry in the new geography, had a gambling problem. He had bet and lost huge sums at the horse races and was heavily indebted to the mob. So that killed that deal. So
Wow.
I realize, due diligence feels like drudgery, but every so often you find something so important that it goes to whether or not the deal should go forward or not.
Can you talk to me more? It was funny, like the surprise is how the majority of them came from the PI. Can you walk me through, like, how do you, 'cause I'm not familiar with it. How do you utilize a PI? Is it a common practice that you're doing on these deals? Is it nature of being a public company? Like, what's driving that?
Well, all the well-known big law firms that specialize in major M&A transactions have relationships with. Some of them have private investigators on staff, employees of the law firm. Others have deep relationships with third parties who specialize in getting to the bottom of, who do essentially sophisticated private investigatory due diligence, nearly always outside the U.S. in the case of a U.S. buyer looking at something outside the U.S. And so this is a very specialized niche, but there are world-class experts who do it generally through big law firms for the big law firms' clients.
And then would you take this approach on all your deals, or is it, hey, it's got to be a certain size for us to really spend the money on this kind of service?
No, you'd only do it by exception.
Okay.
If you're doing a big enough deal outside your home country, if you're entering a new industry, you're entering a new geography, you want to know what it would be like to own and operate the target.
Fair enough.
And what it may have been up to, or in some of these cases.
What's the toughest part of negotiations?
I'll go back to my triage. By triage, I mean, the issues that are easily resolved, the ones that are contentious but where you can find common ground, and the ones that remain zero-sum, winner, loser, no matter how hard you try to identify common ground. So the ones that are easily resolved are easily resolved. So in situations where you've been able, where you think there's common ground, the trick is knowing the lay of the land well enough to identify that common ground, the range from pro-buyer to pro-seller. But being contentious, both sides are going to have to compromise somewhere in that area where they can find common ground. So, as a deal professional, if you're not the CEO, if you're not the CFO, you need to make sure as the negotiator that you have the internal support you need to make the compromises you must to land, hopefully at your end of the common ground, but not where you'd like to land ideally if you had, the CEO, CFO had their way. And then of course, having identified the range of common ground, the art is in negotiating as close to your end of that range as you can, issue by issue. That leaves the intractable zero-sum issues where you've tried hard to identify a common ground, but there just doesn't appear to be a common ground there. Then it comes down to leverage, if the deal is going to happen at all. So if you're the party with the leverage, then you want to be firm because someone's going to have to win. You have the leverage. It should be you rather than the counterparty with less leverage. Firm but reasonable. You're playing with fire. The viability of the deal is at stake. So firm, yes, but also reasonable. Conversely, if you're dealing with these intractable winner-loser, zero-sum issues, and you're the party with less leverage, then you have to avoid what I'll call collective deal fever. Because if you're the buyer and it is strategically important to you and the CEO and CFO to get the deal done, you don't have as much leverage. And so, but you have to guard against strategically important turning into deal fever. I don't care what it takes. We need to get this done. Concede the point. Raise, the offer price. So I think those are the most difficult issues. And it maps to triage. And the question of whether it's strategically important or not to the buyer looms large.
Yeah, there's this point where you got to be not afraid to walk away from the deal.
Yeah.
And is that a tool of leverage where you're like, all right, we can't come to our common ground here. Like, I think we just don't move forward. Like, we're done. And then see, kind of use that as a tactic. Again, we got a little poker face here. Of, are they going to come back? Or like, how do you think through that?
I think, I have, I believe that it can often backfire if you threaten to walk away or issue any other threat and your bluff is called and you don't follow through. That proves the counterparty was right. You were bluffing. So I'm not a big fan of threatening to walk away if we don't get our way.
I wouldn't want to threaten. That's like you pull out a gun, you don't shoot it. Like, you're going to pull out a gun, you better use it. So I guess the goal would be saying, hey, we are walking away.
I think it's a discussion the deal principal needs to have with the top executives. Take their temperature, if you will. Could they really countenance walking away over this issue or that issue? Or is it too strategically important, shading into deal fever? But I think a starting point is being able to talk about the possibility of walking away.
Can you give me an example, like the zero-sum issue?
Well, price, is probably the cleanest example.
Zero-sum, yeah.
Yeah. How much is the buyer willing to pay for something strategically important if they have to? And in order to guard against deal fever, buyers will often set, agree on the largest amount they could ever see themselves paying. But inevitably, that will be put to the test. Did we really mean that was, the most we would ever pay? Because it looks like we might have to pay a little more to stay in this competitive auction to get this strategically important deal closed. That's why it's so important for the negotiators on both sides to figure out whether it's strategically important, a must-have for yourself if you're the buyer, for the buyer if you're the seller. Because if it's not strategically important, then it's just going to be driven by the financial metrics. And at some point, it won't make sense for the buyer to pay even more.
I think that's the only time I'd want to find myself in an auction situation, is if it was extremely strategically important to do this deal. Otherwise, I'd try to avoid it like the plague.
Yeah. Well, if you're the buyer and you have synergies, it would unlock a lot of value if you were to buy it. But none of the competing bidders have anywhere near your synergies. Then you're sitting pretty because you just have to outbid the highest of the other bidders without your synergies. And you pocket the synergies for yourself.
Usually you're blind in these auction situations.
Yeah.
So,
and I think, it goes without saying as often as not, you don't hear the truth from the person conducting the auction.
the banker.
You may have put in, by far the highest bid and be told, well, you're close, but you're not there
How
yet.
do you work around that? How do you make sure that doesn't happen to you?
Well, I suppose the most common approach is to take everything you hear from the person conducting the auction with a grain of salt. Just keep your eye on your own prize. What would be a good deal for you as the buyer? What wouldn't? Try to guard against deal fever, other emotional.
Yeah, I think it's being objective, because the deal fever is what's going to gleam you and pull you towards increasing your offer for the sake of your emotions driving it.
Another way to deal with it is that this is not, valuation is more of an art than a science. You change, one or two assumptions and you get a very different valuation. So you have to, take what bankers conducting an auction tell you with a grain of salt. You also have to take what your internal valuations are telling you with a grain of salt, because they're incredibly sensitive to arbitrary assumptions.
Yeah. That's why I find it really difficult, because bankers' books are always charts that go up and to the right. And then it's difficult to nail your assumptions down with the limited time that you typically have on a deal.
It's easier to get better if you do a lot of deals and you do postmortems on them. Then you can calibrate your approach better. Saying, 4 out of the last 5 deals we did, it looks like we overpaid with the benefit of hindsight. That tells you something.
Is there anything specific you do to retain those learnings somewhere, just so that they don't get forgotten, or is it just simply the conversation that keeps it in mind?
Well, we at CF we have a process, where we routinely do 1 year and 3 year and 5 year check-ins as a way to calibrate our thinking about valuation. So if you have that process, you capture the learning automatically, and it gets discussed rather than just filed away.
Surprises between sign and close.
I don't have any as exciting as hiring private investigators, but
you would do that before you got to sign.
yeah. I'll just talk about it in general terms. If there's going to be a meaningful delay between signing and closing, regulatory clearance, for example, maybe difficult financing, but in any event, a significant delay between signing and closing, you always have to bear in mind the risk that market, including capital market conditions, could deteriorate over the months in question. If you look at the deal landscape, there have been many examples of deals signed before the financial crisis, let's say, and pending closing when the financial crisis hits. But the thing about deteriorating market and capital market conditions is that it gets buyers, rethinking their willingness to do the original deal they signed, and in more extreme cases, even their ability to raise the financing, for example, and close. And adverse market developments aren't the only risks. There could be other material developments between signing and closing. in a deal that needs regulatory clearance, and everyone thought that would be easily obtained, more and more in the U.S. and many other countries around the world, it's getting harder to get deals cleared. And that often takes the form of unexpected, unpleasant surprises between signing and closing. In deals involving public companies, stockholder activism could emerge. Believe it or not, it's not uncommon to find activists saying to the buyer, "Oh, you're paying way too much. You probably shouldn't even buy this company." And other activists going to the target company saying, "Oh, you never should have signed that deal. You're not getting paid nearly enough." And roughly half of stockholder activism now is deal focused.
Wow.
And as often as not on both the buyer and the seller side. So that's something to bear in mind if there's a long period between signing and closing. Sometimes the synergy, the value, if you will, for the buyer is inherent in the tax regime, in the regulatory regime. It's not unheard of for that ground to shift, maybe even dramatically between signing and closing. There might be a lawsuit, major regulatory investigation aimed at the target between signing and closing. As we sit in 2023, there are crises everywhere you look. And so a crisis might develop affecting the buyer or the target between signing and closing. So I think, given all the things that could happen, these are some of the most heavily negotiated provisions in acquisition agreements, how to deal with them if they do come to pass between signing and closing, and why it's really important to have excellent lawyers on both sides there. People who do deals for a living have developed what I'd call market approaches to allocating the risk between buyer and seller of one or more of these things happening. So it typically isn't all that bespoke. There's no reason to reinvent the wheel. The answer is just to get top lawyers who know their way around deals to deal with it in the acquisition agreement and then hope for the best, that all's quiet.
These are a lot of good examples of the variety of things that could come up.
Yeah.
What do you think after close is the biggest risk around integration?
Well, I think the single biggest risk is loss of talent or demotivation of talent at the target. That's off the charts important in tech and also in professional services. Because, as the old saying goes, the assets of such companies go home every evening. They're not tangible assets.
Yeah.
And so it's really important heading into integration, during integration, for months and years after closing, to make sure you don't lose key talent and that they remain motivated to keep doing what they had been doing, making the target so attractive when you bought it. There are various ways to mitigate that risk. You can defer liquidity for key individuals at the target because there's nothing like having all of the purchase price cash on the barrelhead and then decide you don't really enjoy your job as a subsidiary as much as you enjoyed your job pre-IPO, pre-sale. So deferring that liquidity for 1, 2, 3 years can eliminate the temptation to just take the money and move on. Seller non-competes have been a classic approach for years, but now their legality and enforceability are being called into question in the U.S. and elsewhere. So that's the efficacy of seller non-competes, is kind of a question mark today. And then the classic, carrots, incentive retention packages, making it well worth people's while to remain engaged at the new subsidiary. But I think there's ultimately no substitute for having a work environment that people want to join and that people are loath to leave. Because handcuffs, incentive packages, and the like, seller non-competes if possible, only go so far. People have to genuinely want to stay and want to do their very best. So I think people are naturally drawn to workplaces with an appealing culture, an exciting strategy, a rewarding mission. At my company, CF, for example, we have a wonderful, robust culture that we call Do It Right. It has 4 components. Worker and public safety, because in the chemical industry, safety is of paramount importance. We have, the second element is inclusion and diversity, because we feel we want the very best people. And so CF has become a very diverse and very inclusive company. And that has led to the most talented, diverse candidates wanting to join CF when they have other options. So it's a virtuous circle. Third element, legal compliance, business ethics. That's a very important part of doing it right. Yeah. And finally, environmental stewardship. Being a chemical company, we have a major impact on climate change, for better or worse. So we, turning from culture to strategy, briefly, CF 3 years ago announced an utterly new and exciting strategy. We call it clean energy. And our strategy involves making dramatic and rapid reductions in our carbon footprint. In order to produce a carbon-free product, ammonia, that is a drop-in substitute for fossil fuels in certain applications. So not only are we reducing our carbon footprint rapidly and dramatically, but we're supplying our customers with a carbon-free substitute for fossil fuels, enabling them to reduce their carbon footprints in turn. And so, it's a very, very exciting new strategy, and one of the reasons, we have great people who want to join the company and great people who wouldn't dream of leaving it.
It's actually a good theme here in terms of the biggest integration risk being people. You lose people, you're going to lose a lot of value, and more so depending on the industry you're in.
Yeah.
You have a few different ways to either defer some of the liquidity that they have, just non-competes, but question how enforceable they are. And then creating the carrots, the retention package. And then culture, almost like building your company culture as a synergizing of its own, so that people are really excited about it and allow that to carry the value. And
I've become convinced it's a huge competitive advantage to have the right culture, and it helps more than a little with integration. particularly if the key assets of the target are the people.
Yeah, I don't totally agree. I think it's interesting to see how some companies really do that well versus others that don't. And 'cause we all know what happens when that doesn't get aligned. Do you have any examples of like the biggest challenge you've seen in M&A?
I do, and in some sense, it's my second of two war stories. I told you about taking the money-losing company public the same time as Google and outperforming Google for the next 10 years. That was my first war story. This is my second of two. During the financial crisis in 2009, early 2010, we found ourselves in a four-way cross-border takeover battle. We had made a hostile offer for a competitor in the U.S., and a few weeks later, a bigger competitor in Canada made a hostile offer for us.
Oof.
So we were simultaneously playing offense and defense for over a year. Then a fourth company entered the fray, a European competitor, by some measures the largest of all, and it made a friendly offer to buy our U.S. target. And that deal was signed and announced. At that point, the large Canadian company coming after us said, well, we're still interested in acquiring CF. So it looked very much like you could see the final outcome. The European company would buy our competitor in the U.S., and the Canadian company would buy us, and that would be that. But being a lawyer, I realized that at the other company in the U.S., once they announced a deal to be acquired by the Europeans, legally speaking, it turned it into an absolute auction. The board of the other company in the U.S. really had no choice, legally speaking, but to sell the company to the highest bidder. And so I recognized that, and I engaged in extensive consensus building within the company, up to and including our board, our investment bankers, everyone, and convinced them we should put in a topping offer, outbid the Europeans for the U.S. company we wanted to buy. So we did that. It turned out the European company only had one bid in them. So at that point, we won the contest, if you will, to buy the other company in the U.S. We doubled in size with that acquisition. And that made the combined company now twice as large, too big for the Canadians to handle, so they dropped their pursuit of us.
Wow.
So we doubled in size against all odds, to everyone's astonishment. We were the underdog throughout, right up until the end when we made the winning move. And it was a great acquisition. The combined company outperformed its competitors markedly for the next several years. So if it wasn't for recognizing the winning move and convincing all my colleagues to make that move, we would have been taken over, and that would have been that.
Well, that's quite the dance. That's
You don't see hostile takeovers nearly as much today as you did for decades. Now it's all about stockholder activism.
Do these hostile takeovers, do they like start off friendly and then get hostile, or are they just hostile from the get-go?
Most, but certainly not all, start out with preliminary friendly discussions between CEOs about putting the two companies together. Mm-hmm. Those rarely result in mutual agreement. Yes, let's put the two companies together, I'll run it, you'll depart with a nice package. And so even the typical ones that start out with a friendly discussion eventually turn unfriendly in one way or another. Sometimes the fact that it's turned hostile becomes public. Other times the hostility is behind the scenes and only inferred by the public.
With all the experience, 40 years doing deals, 100 plus deals, let's back it up to the first timers.
Yeah.
Companies like us that I don't know when it'll be, but eventually we're going to do our first deal. What's advice you'd give to us so we don't screw things up?
Well, I would say the best general advice is do as many deals as you can and learn from the very best.
That's what we're talking.
Yeah. Sooner or later, though, sometimes in the natural progressions, other times much earlier than you were anticipating, you're suddenly, flying solo. You may have been thrown in the deep end of the pool before you were prepared to run your own deal. Other times, you've had a good training and you're ready for it. But either way, odds are you've been given that responsibility for a reason. And you wouldn't have been given that responsibility if the people who gave you that responsibility didn't think you were up for it. So, embrace the opportunity to learn by doing. If you've been thrown in the deep end of the pool, instead of schooled for several years, you may make mistakes. But in any event, you always have the option of going back from time to time to the people who trusted in you, who gave you the responsibility, and saying, "Oh, this is a tough challenge. I was not expecting this curveball." But it's a combination of doing a lot of deals, learning from the most talented people you encounter in those early days, and then handling the transition from being part of a team to running the show.
I agree with you, Doug, because you can't read a bunch of M&A books and be promptly prepared to go do a deal. I think you're right. If you can get exposure without taking the risk, like that's good. Or having that network, knowing folks like yourselves that have that experience that I can say, hey, here's the situation I'm encountering on, help me think through this. I feel like that's personally been way more valuable than anything else. Otherwise, you stand to learn it the hard way.
I'm a big believer in learning by doing. I wanted to learn about futures and options, and I took a course in it, but I didn't feel I really understood it as well as I should. So I took a small sum, but a lot at the time, opened a retail account to trade futures and options, thinking that nothing would cement those lessons like playing with real money and all that leverage. So I'm not risk averse when it comes to learning new things. I think you need enough risk that you pay attention, you bring out the best in yourself as you learn to master it.
So I guess in the context of M&A, go do a deal, but just do one you can afford to take a hit on.
Yeah.
Doug, what is the craziest thing you've seen in M&A?
I gave that one some thought. I was at a strategic buyer, and we were negotiating to buy a target, new industry for us from the entrepreneur. And under pressure from the president, I found myself insisting on an extreme earnout. That the entrepreneur was going to come to work for our company, running our new subsidiary, the company he'd built to that point. So the earnout ranged from literally zero purchase price for him if our new subsidiary, meaningfully underperformed his forecast, all the way from literally zero, not even a fixed amount, to a princely sum if it blew the doors off under his leadership as our new subsidiary. And it was sized so that even if he got the princely sum, it would be more than self-funding. There would be enough for us in that amazing outperformance that we would gladly give him the princely sum for having led it to those heights. To my astonishment, and I think the president's astonishment who put me up to it, the entrepreneur, without blinking, said, okay, we'll do it that way. We bought the company, it became a subsidiary. The entrepreneur came to work for us running our new subsidiary. 4 years later, he had blown the doors off. We were ecstatic because it was self-funding with how well we were happy to give him the princely sum, so princely that his name is now on the side of a well-known college football stadium. So I still don't know quite what to make of that other than the entrepreneur was supremely confident.
Yeah, you gave him the all-in option.
Yeah. So we had nothing to lose. We would literally have a new subsidiary for free if it zeroed out.
Yeah.
And have made it enough that we'd be more than happy to give him his princely sum if he blew the doors off.
That's crazy. I hope I get an opportunity to put a deal like that on the table. Like, hey, let's go at it. Todd, this has been great. I want to thank you so much for taking the time to have the conversation with me. I enjoyed it. I learned a lot. You've helped me become a better M&A scientist.
Well, I really enjoyed it too. Thank you.
Hey, those of you still tuned in, thank you for getting this far. Until next time, here's to the deal.